In just about every culture, we have a saying that sounds something like, you don't want to put all of your eggs in one basket. Well, modern portfolio theory has pretty much built in a lot of that logic that's, pretty much as old as recorded history, and said, when you're building a portfolio, you want to make sure that you have a fully diversified portfolio to minimize risk and maximize return. It was such an incredible idea that it resulted in at least one Nobel Prize, even though, of course, we know at its root, it is really just our common sense. Today we're going to talk about portfolio diversification and the role of asset class correlation. And in particular, we'll take a look at the importance of diversification, the role of asset class correlation in producing a well-diversified, efficient portfolio, and we'll also talk about the way that this works in a relatively simple portfolio, a simple two-asset portfolio, both for domestic assets and also for an international portfolio. And we'll talk a little bit about the benefits of international diversification. Now, I did mention that Nobel Prize. In fact, Harry Markowitz in 1952 produced a simple explanation of the logic behind diversification that was so remarkable that it became the foundation of what we now describe as modern portfolio theory. In fact, in 1989, he received the Nobel Prize for this particular idea, followed in subsequent years by some of the other people who wrote about this, like William Sharpe, who we'll also talk about in today's session. Sharpe won the Nobel Prize in 1990. From our textbook, the Jordan textbook, we use a number of tables today, and so I just wanted to make sure that we give them credit. One of the tables from chapter 11 discusses the importance of having multiple stocks in a portfolio. Essentially, it says that if you have a one-stock portfolio with information from this table, you'd expect a very high standard deviation, about 49%. By adding a second stock to the portfolio, that reduces the standard deviation to 37%. 4 stocks in the portfolio, we have 29 or 30% standard deviation, and so on. By the time we get to, say, 20 stocks in the portfolio, we have a standard deviation of only about 21 or 22%. And if we have 1,000 stocks in the portfolio, well, that's going to fall to about 19.2%. So certainly to a particular point, you can see the rate of, or the standard deviation decline is quite steep until we get to a certain point. And we can see that when we take a look at this type of a diagram. On the vertical axis, we have standard deviation as a percent. So if you've only got one stock in the portfolio, then you have a very high standard deviation at 49%. Add 2, the standard deviation drops, add 3, and so on. And then by the time we get to about 20 stocks in the portfolio, you can see that we have reduced that risk substantially. And by the time we get to 25 stocks, the additional benefit from increased diversification is probably going to be outmatched by the information cost of keeping track of so many stocks. So you can see why advisors would suggest that perhaps you have at least a dozen stocks in any kind of a portfolio, even a small one, and that if your portfolio is going to get much larger than that, perhaps you'd consider adding more until you get to a point where you're following perhaps 20 investments. And there is some controversy now about how many stocks we can manage to follow, with some advisors saying that they can follow as many as 100 or even 200 stocks. I know from practical experience, trying to follow on a day-to-day basis more than 20 stocks would seem impractical. What we see that Markowitz defined with this particular view of the world was that there are 2 different types of risk. There are the risks that you can diversify away. So by holding 5, 10, 20 stocks in a portfolio, we have a certain type of diversifiable risk, which is reduced almost to nothing by the time we get to 25 stocks. What remains after we've diversified that risk is the non-diversifiable risk. We also call the diversifiable, the firm-specific or the idiosyncratic risk, or the unique risk, the risk that's unique to the firm. When we talk about the capital asset pricing model, again, product of academics like Bill Sharp, we have encompassed that by saying we have the risk-free rate, and then we have the beta times the market premium. Well, basically that's our diversifiable risk. So what we've talked about in our corporate finance courses becomes increasingly relevant here. There is something else that you might hear about, and certainly you can read about in Chapter 11. And it points out that the benefit of diversification comes from holding unique and independent stock investments, especially ones which are not highly correlated. There isn't a real benefit of diversifying over time. And other academics like Paul Samuelson and Robert Merton wrote about this also in the 1950s, saying that people do have a false belief that risk decreases with the holding period of the portfolio. We can see from this particular table that we also have from Chapter 11 that if we look at the long-term performance of stock markets, we see that the expected return, or the average rate of return from a portfolio of all equities in the United States over a very long period of time was about 11.9%. The standard deviation of those returns about 19.8%. And if you were to ignore the benefit of time, you'd say that, well, that same portfolio over a longer period of time would only have a return of 9.3%, but the standard deviation of return would fall to 0.7%. Well, what we would say that is a fallacy. It's not something that we'd expect that would hold true, because even though for most investors the holding period for a fund is going to be much longer than that, the standard deviation is not a number which is essentially cumulative. We can see that when we take a look at the dollar returns to that portfolio. So that, yes, it would be true that if you did invest in a portfolio and the 1-year returns, or the 1-year stock of wealth would rise from, say, 1,000 to 1,118 over that period, giving you the 11.9% rate of return, the standard deviation of that wealth within the 1-year window would be $198, or essentially it would be 19.8% of the principal amount of $1,000. If you use the same numbers over a 40-year period, you could see that the actual dollar value of the funds at risk would be very high. So your expected return at an 11.9% rate of return would be $50,000. But the standard deviation would be a heck of a lot more than 0.7%. So in dollar terms, or wealth terms, the value of the standard deviation would be a lot greater. So we can say that wealth volatility does increase over time, even though the percentage of standard deviation doesn't. So essentially, investing in equity has a greater chance of producing a very large value, but it also increases the probability of ending up with a really low value. And we hear this fallacy repeated quite regularly. In fact, in 1990, Vanguard, one of probably the largest fund manager in the world at the time, said in one of its publications that the volatility of the stock market returns diminishes markedly over time. Stock market risk hardly seems excessive for even the most cautious investor. Well, as we say, this was essentially proven to be wrong by those great academics Samuelson and Merton. And we regularly hear this repeated over and over again. Now, does this actually mean that young investors should not invest in equities? Well, young investors are equally likely to lose money in the long term, as shown by this chart. You can see that over the holding period from 1 year to 39 years, if you are one of those investors that are holding for the full 39 years, the expected return, or the median return, lies someplace in here, that we expect to see an original investment of $1,000 turn into $40,000, or I think it was closer to $50,000 in that chart that we saw before, with an average standard deviation of about 11.9%. In the extremes, you could have, we'll say, a 1 in 6 chance, or if you're one standard deviation away from that mean, you could end up with a return of 160,000. You could also end up with a return significantly less than that, minus 1 standard deviation, closer to $20,000. So, yes, there is still only a very low standard deviation cumulative over that period, but we take our chances on an annual basis. Should young investors invest in equities then? Well, a better reason for young investors to invest in equities is that they have a very long period over which to make up any losses that happen in the short term. So perhaps losses in the first couple of years of investment will still be losses. However, in the next few years, they'd have a chance easily to replace any of that lost wealth. So it makes more sense, if you're worried about liquidity, to invest in equities markets. Getting back onto the main theme, diversification. Diversification is partly about the random benefits. Markowitz, when he wrote his original paper, said that we don't really have to prove that there's any kind of benefit from lack of correlation. You can just randomly pick 10 stocks or 20 stocks from a single index, and by combining those, you're going to reduce most of the risk. We could probably do even better if those investments were not correlated. And so that's going to be the next part of this video. We're going to talk a little bit about the benefit of correlation, or rather lack of correlation. Essentially, correlation is the tendency for two assets to move together, things that are going to happen in common. Imperfect correlation is the reason why diversification tends to reduce portfolio risk. And of course, we measure this by taking a look at the standard deviation and the variance. Positively correlated assets tend to move together. They have a number that is between 0 and +1. So they have a positive value for the correlation coefficient. Negatively correlated assets move in the opposite direction. So when one goes up, the other will go down. They'll have a value between 0 and -1. We tend to expect that imperfect correlation is going to be pretty much standard, some value that is going to be somewhere in between +1 and -1. And as long as the value is not equal to 1, we see there's some kind of a benefit from diversification. For the purposes of this exercise, we're going to describe the correlation coefficient using the notation correlation of asset A, the rate of return on A, with correlation of B. Sometimes we see the Greek letter rho used, R-H-O. And so basically this is saying the same thing, the correlation of A with B. And as mentioned earlier, -1 is a measure of perfect negative correlation. That means for every dollar that our return goes up with one asset, we lose $1 with the other. 1 means we have an increase of $1 for $1, and 0 means anything can happen. There is no observable relationship. So we do see that some assets do tend to typically move together. For example, we might see that the value of oil companies go up with the value of oil. There's a correlation. It's not perfect because oil companies are made up of other things than oil reserves, but there's a high correlation. We might see a negative correlation. For example, we often see a negative correlation between airline stocks and oil companies, because when oil companies go up, the price of oil has gone up, and when oil goes up, the cost of operating an airline heads in the opposite direction. We can see that when we take a look at company examples like this. For example, two companies perhaps in the same industry, driven by the same cost pressures and the same growth opportunities, A and B. They don't have the same levels of return, but the direction is always going to be the same. So we have got some kind of a positive relationship. So A and B in the first table, we have the same direction with roughly the same magnitude. An inverse relationship, or perfect negative correlation, the example of the oil companies and the airlines. It tends to be a good one, where whenever the oil company is having a good year, the airline is likely having a bad year. Zero correlation indicates some kind of randomness, and sometimes we do see that behavior is random. For example, I often observe that certain mining companies tend to behave randomly, and that's because people hold minerals like gold for purposes other than investment. So when the rest of the economy is doing well, gold might be doing badly because people that hold gold as a hedge against catastrophes are less likely to hold on to gold. Well, some people hold gold because they need it to produce products. So there's no direct relationship. And perhaps when the economy is doing badly, some of the convenience yield, or the users of gold for manufacturing purposes, aren't buying it, but people hold gold because they're concerned about maintaining some kind of store of value or as a hedge against inflation. So we might see randomness as a result of that. Just the values are not driven by the same things. Here we can see an example of perhaps not random diversification, but we have two stocks, A and B, and we're looking at the annual returns for those two stocks. If you held on to stock A for the entire period of 5 years, from 2015 to 2019, the average return for stock A would be 9% with a standard deviation of 14.3%. Easy to calculate, something we covered earlier in the course. Held on to stock B, well, the rate of return is higher and it has a standard deviation of 13.5. Now, when you look at these two together and say, well, the average standard deviation for the two is about 14%. The average return is about 11%. Well, we were right about the return. It was 11%. But we seem to be very wrong when it comes to the standard deviation. Standard deviation is not the average of the standard deviation for the two. And that's partly because the behavior of the stock in each of these years appears to have been quite different. Now, we can see that when we take a look at these tables. Here we have the annual performance of the returns for Company A. In particular, we see that 2017 was a very bad year. The rest of the years, well, quite a bit more volatility with A than with B, but B didn't have a bad year in 27. In fact, they had a really good year in 2017, and 2016 was their bad year. So when you take a look at the average returns for A and B, the best years for A are balanced out against the worst years for B, and so the standard deviation of the returns from a portfolio equally made up of these two stocks would not be too great. We'd have a much lower standard deviation. When we talk about correlation, correlation doesn't just happen between stocks, it also happens between types of stocks. This is actually a table, a matrix of correlations for a variety of different classes of assets. And both across the top and across the side, you can see we have the same items. We have U.S. large cap, very large companies with high growth, and the correlation of one thing with itself tends to be 1. So if we look across this axis, we can see that whenever large cap value stocks, mid cap, foreign bonds, whatever the asset is compared to itself, it comes up with a correlation of 1. Now, that's no surprise. And whenever we're looking at a correlation matrix, essentially we see a reflection across this diagonal axis. So when we take a look at large cap value stocks correlated with large cap growth stocks, they have a high correlation at 0.84. When we look at large cap growth stocks compared to large cap value stocks, it's the same comparison. So across this diagonal, we see that those numbers are exactly the same. So you can pretty much ignore half the numbers on this table. That's true for a correlation matrix, not true for a covariance matrix, something we might talk about a little bit later. What is particularly interesting, though, we can see that without looking at some of these extreme comparisons like cash, when you compare something like, well, let's say we're comparing investment grade bonds with small cap stocks, the value is very small, because whatever makes the economy attractive for small cap stocks is pretty much the opposite of what gets us to invest in investment grade bonds. So there is a really low correlation, and low correlation is our friend when we're looking for diversification. So we would try to create a portfolio by creating investments which have the lowest correlation coefficient. When we're looking at portfolio risk, and without getting too heavily into the calculations, we can see that there is essentially going to be two sources of volatility that are going to affect a portfolio of different assets. There's going to be the unique volatility that's going to be attached to an individual stock, in this case stock A or stock B. There's also going to be the correlation. And so when we're looking at a calculation that's going to involve these items, essentially we say that the volatility of our portfolio, subscript P represents portfolio, and sigma squared means we're looking at volatility and not the standard deviation. Well, it's going to depend on the volatility that's attached to stock A and the volatility of stock B. It's also going to depend on how much of stock A and stock B we have. So X is the weight. So we have a measure of weight of stock A and stock B. So first question, how much have we got and how much volatility have we got? So the volatility of our portfolio depends on the volatility of the two independent stocks. The third factor is this one here. So for a portfolio with only two stocks, the covariance term is the one that interests us the most. Essentially it says we're going to consider the covariance of stock A and B multiplied by 2 times the weights of each. Now, essentially when we're looking at the next line, all we've done is expanded that by saying that our calculation of the, well, in fact I'll just highlight that separately, this part here, that the measure of covariance is equal to the standard deviation of A, sigma A, times sigma B, times the correlation, not covariance, correlation of the return of A and the return of B. Okay. This is a couple things. Number one, if you are nervous about looking at the equations, don't panic. This is not something that we have to do on a day-to-day basis, and also this type of calculation is not something that we're likely ever to have to use, because nobody constructs a portfolio of only 2 stocks. In fact, if we're looking at a 3-stock, which we will look at in a minute, a 3-stock portfolio, we need a couple of extra terms, and if we had a 10-stock portfolio, we'd need a whole matrix. So we would not in practice do this kind of calculation. It just wouldn't be terribly useful, but it does help us to understand the intuition. When we're looking at a portfolio with a number of different diversification opportunities, here we can see an example where we have 2 different types of investments, stocks or bonds. We don't really care what kind of stocks or what kind of bonds. We just say we have a portfolio of stocks, we have a portfolio of bonds. If we go for an all-equity portfolio, this one on the top, and 0 investment in bonds, we can see that on average historically the expected return was 12% and the standard deviation is 15%. At the other extreme, we could go for a 100% bond portfolio and a 0% equity portfolio, and if we did that, we'd get a 6% rate of return and a standard deviation of 10%. What you actually see by looking at the intermediate values, that something interesting happens here. We can see that the standard deviation becomes less and less as we add more bonds into the portfolio, but at some point we end up with standard deviation that decreases to as low as 8.69, but then increases as we add more bonds into the mix. So it looks like there's kind of a magical portfolio here where we have got 30% equities, 70% bonds. It gives us a rate of return of 7.8, which is certainly higher than a more bond-intensive portfolio below that, but it gives us the minimum variance, the minimum standard deviation. And that is important because we describe that as the minimum variance portfolio. Let me just write that down here just to remind myself. Minimum variance portfolio. Well, we can see this also if we were to put it onto a chart, which is what we're going to do next. Here we have exactly that same information. So we can see we have at the very top, we have the portfolio that was at the very top of the table. Has about a 12% expected return, with return on this, and the risk is across the bottom, standard deviation, and so we had the highest level of risk. Now, that would be the all equity, 100% equity, 0% bond portfolio. And at the bottom of the table, we had the standard deviation of 10 for our 100% bond portfolio and 6% rate of return. Now, when you start to look at this a little bit critically and say, well, I kind of like the points that are along this line because they represent a trade-off of decreasing risk with decreasing return. Remember, risk and return, that's what all of this is going to be about. But if you're at a point like, well, one of these points down here, you have a low level of return in exchange for, well, a relatively higher rate of risk than we see with some of these values on the line. So any point that's below this risk-return line is suboptimal and one that we would tend to ignore. So we would invest in any combination of portfolios along this line, but nothing that's below the line because that is a wasted trade-off. We're taking on increasing risk for less return. Now, that started to produce an idea, and this is really what Markowitz won the Nobel Prize for. He identified an efficient frontier. Anywhere along this line is our efficient frontier. And when we add to that a risk-free rate, we've produced the logic of essentially the capital asset pricing model. Now, this is starting to look a little bit more complicated, but give me a second and I'll talk you through some of the logic in this. Essentially here we have three different types of correlation. Again, we've got the return on this side, the risk or the standard deviation on this side. So any place as we move towards the top and the right-hand side of this chart, we have got a better risk-return mix. Any place down towards the bottom, we have much less risk and much lower return. If we were going to look at a decision to have stock A or stock B or some kind of a combination of the two, either all stock B, which would put us down here, or all stock A, which would put us up there, if we have a perfectly positively correlated pair of investments, we can invest in stock A or B and they have a correlation coefficient of +1. We would operate someplace on this frontier, someplace on that line. If they have a negative correlation, a perfect negative correlation coefficient, if we had 100% stock A, we'd end up here. If we have, say, 25% stock A and 75% stock B, we'd end up there. If we're at 50-50, we would end up with zero risk, because essentially whatever we've bought of stock B would be offset by stock A. Remember the airline stock and the oil company stock. So we've got the two. And in a worst case scenario, in our worst year, we'd lose a ton of money from having the airline, but we'd make a ton of money from the oil company. So it would give us a riskless portfolio with two stocks. And it would give us pretty much the guaranteed minimum rate of return of 8-point-something%. Any place on the bottom line would be suboptimal, as we pointed out. Why would we hold on to more than 50% of stock B? Because it would put us on this bottom line. And if we have the zero correlation case, we're on this pinkish reddish line, and so we're going to operate someplace on this curve. So we'd be happy to operate right up to the minimum variance portfolio, where the return, where the trade-off is actually going to be unhelpful. So essentially, these are three special cases of Markowitz's efficient frontier for each of those special cases. When we start to take a look at having a lot of different kinds of assets, for example, and this is from the textbook, and the textbook does give us all of the data that we need to interpret each of these lines individually. You can see that we could invest in a portfolio made up of two things: U.S. bonds and foreign stocks. And the data that's in the book tells us that foreign stocks have an expected return of 18%. So if we went for all foreign stocks, we'd be way up there. But along with that comes a standard deviation of 35%. And we could, in this particular trade-off, U.S. stocks versus foreign stocks are 18%. U.S. stocks are 12%, which would put us down here, but with a lower standard deviation, 22%. U.S. bonds, 8% and 14%. So that's why we're back here at 14. So we're someplace along that curve. We could look at the same trade-off for U.S. bonds and U.S. stocks. That's the brown line. We could look at the green line, which is U.S. stocks and foreign stocks. Or we could actually have some kind of a combination of combinations. You could have a portfolio made up of two of these or three of these, and ultimately it helps us to produce a frontier that looks like that, where we can trade off between multiple different classes of assets, each of which has got different correlation coefficients, each of which has got different lines for our efficient frontier. The calculation may actually be a little bit more complicated when we start to put together multiple assets. So far, we've only talked about portfolios made up of two things. You could have a portfolio made up of 3 things, or 4 things, or 5 things, or 10 things. The problem is the computation starts to get a little bit awkward. Calculating return, really easy. Essentially, the return to our portfolio for a 3-asset portfolio is just the weight, X, times the return, R, for each different types of assets. So if we have foreign assets, stocks, and bonds, as in the last example, we have the first term, which is just the weight times the return, plus the second term, the weight of stocks times the rate of return for stocks, plus the third term, the return to bonds, plus the rate of return to bonds. When we start to take a look at the variance, that term becomes a lot more complicated. So we have got essentially the first 3 items. We have the weight of foreign stocks times the variance of the foreign stocks, plus the weight of domestic stocks, S, times the variance of those domestic stocks, and then same thing for bonds in the third term. But on top of that, we have to add the correlation statistics for each of those. And so for that we have to calculate, well, remember we said we could do this by rho, 2 times the x sub f times the x sub s times the, you kind of get the idea there, times the rho of r sub f and r sub s. So we can calculate that for the foreign stocks, for the combination of the of the bonds and the foreign stocks, and then the domestic stocks and the bonds. And so do that for each pair. In this case, it's going to take 3 more calculations. Already pretty messy. Imagine if we added 4 stocks and 5 stocks. Well, if we say that these assets are not correlated, if they have 0 correlation, then we could just use the simple version down here. But there's always going to be some kind of minor correlation, even for stocks that have got very low correlation coefficients. So, as I say, that's why we come back to different classes of assets and decide how to put together a portfolio and to create new minimum variance portfolios by saying we have got a lot of exposure to U.S. equities. Perhaps it's time to add some U.S. bonds or some foreign bonds or some emerging market bonds or real estate, commodities, cash, in order to create a portfolio which gives us the best return for the lowest amount of risk. To determine whether or not we've done it right, we look at certain types of measurements, or we like to say metrics, and probably the best accepted metric is one that was produced by William Sharpe. And remember I mentioned William Sharpe at the beginning. He won a Nobel Prize essentially for providing a look into the effect on portfolios of risk, or producing a risk adjustment. The Sharpe ratio starts off by saying, what kind of a return did we get that was really exceptional? And that's the numerator. And essentially we describe this as the alpha, the return to the portfolio in excess of a risk-free rate. So if we've said the risk-free rate for our type of investment is a 5-year bond and our portfolio produced X level of return, we just subtract the risk-free rate and say, look, we did so much better than our benchmark. And the benchmark might be, in some cases, some kind of an equity market return or risk-free rate of return if we're looking at bonds and so on. We compare that to the measure of risk for the portfolio, or the standard deviation of the portfolio. So the larger the standard deviation, the less impressive our alpha is. If we took on a ton of risk, if our standard deviation is a really big number, then that makes the Sharpe ratio smaller. It makes it harder to impress us with a fantastic rate of return if the level of risk was also fantastic. So essentially it's a risk discounted level of abnormal profits, abnormal returns, or alpha. So, yeah, as we say, in other words, the Sharpe ratio, a measure of excess return per additional unit of risk. If you want to be a good manager, then you have to produce the highest Sharpe ratio. The highest raw returns really aren't meaningful because perhaps you took on a lot of extra return to create that extra. So you took on a lot of extra risk in order to create that extra return. By creating and using diversified portfolios using domestic and international types of investments, we can reduce the overall riskiness of the investment and make the return look better. Well, actually make the return better, not just look better. An example of how a portfolio that's made up of both domestic and foreign assets follows. In this case, we have certain information. The standard deviation for foreign assets is 15%. Standard deviation for domestic assets, stocks let's say, is 12%. The correlation coefficient for domestic and foreign assets is 0.55. The expected return for foreign is 12%. The expected return for domestic assets is 10%. And in both cases, the risk-free rates for domestic and foreign assets happen to be equal at 4%. So we could calculate the Sharpe ratio for both types of assets and also for a portfolio that was mixed. In this case, we'd say that the portfolio rate of return was 10%. So we have a 10% rate of return to our portfolio for domestic. We have a risk-free rate of 4%. So 10 minus 4 gives us the alpha of 6%. And the standard deviation for our portfolio is 12%. So 6 divided by 12 gives us a Sharpe ratio of 50% or 0.5. For our foreign assets, we said there was a 12% rate of return on our portfolio, still a 4% risk-free rate, but the standard deviation for the international portfolio is higher at 15%. And so that means the Sharpe ratio is 0.533. Already it looks like the foreign portfolio is a better deal. If we had to choose between one or the other, at this point we'd say, let's go with the foreign portfolio. It gives us the best Sharpe ratio. We can actually say, what if we had a portfolio that was made up of half domestic and half foreign? In this case, we can see the rate of return is just the weights times the return. So if we had 50%, 0.5 is the weight, or X, for the domestic, and 50% is the X for the foreign, and we have the expected return of 10% for domestic and 10% for foreign, the weighted average return of a portfolio made up of half and half would be 11%. The math on that one's pretty easy. The calculations for a two-asset portfolio, domestic and foreign, of the variance, standard deviation in this case, for our portfolio would depend on the weight of domestic, the weight of foreign, the variance of domestic, the variance of the foreign, and then we have finally our covariance term. And so it's 2 times the weight of the domestic times the weight of the foreign times the correlation coefficient times the standard deviation domestic and foreign, and we take the root of that in order to take the variance and turn it into our standard deviation. The numbers we see down here, just plugged into that model. 50% weights of each, okay, that's easy. And 12% was the rate of return for domestic, and 15% was the rate of return for the foreign. Again, all of that's pretty easy. And then we take the 2 times, well, that's the constant we used up above, and then the 50% weight, the 50% weight, the correlation coefficient of 0.55, and then we have the standard deviation of domestic, standard deviation of the foreign. Take that all to the square root, or to the 1/2 power, in order to turn the measure of variance into the measure of standard deviation. Well, all of that gives us the standard deviation of our mixed portfolio is 11.91. Now, the purpose of this, of course, was to calculate the portfolio Sharpe ratio for a 50% domestic and 50% foreign portfolio. The expected return was 11%, and we're going to use that. The risk-free rate is 0.4 either way, and the standard deviation that we just calculated quite painfully was 11.91%. That gives us our overall Sharpe ratio of 0.58 or 0.59. Now, recall from the previous slide that a domestic portfolio had a Sharpe ratio of 0.5. A foreign portfolio had a Sharpe ratio of 0.533. The mixed portfolio with a correlation coefficient of 0.55, actually a lot better at 0.58 or 0.59. So we would actually be substantially better off by mixing our portfolio. You recall from earlier on, we looked at how this would tend to work, or how Markowitz's big idea said that we would start to benefit by having a portfolio that was made up of diversified domestic stocks. Well, when we actually use more international stocks, we create a whole new set of possibilities. So from this, you could see that if we stuck with our US stocks, our idiosyncratic risk disappears around 25 stocks, and that's always going to be true. But the non-diversifiable risk is about 25%. If we have an international portfolio, we can reduce further the non-diversifiable risk and end up with a lower rate of risk if we go for an international portfolio. And for this reason, we start to look beyond diversifying through asset classes to diversifying with a foreign portfolio. Of course, we can see that international diversification was a fantastic thing to do in the 1960s and 70s and 80s. Right through until the end of the 1980s, we saw that there was very little contagion of things that would affect one market. An oil crisis could affect the United States and not affect the rest of the world. By the time we get to the 1990s, we're starting to see global crises, either caused by political interference or political risk, but also by commodity shortages and financial crises, like 2008 was a great example. Affected a market in the United States, which then spilled over into Japan, which then spilled over into the rest of Asia and into Europe, and pretty much everybody in the world has the same problem. So that has resulted in a decreased benefit from diversification because of increased correlation between markets. So those correlation coefficients, as they get to be larger, means that we have less benefit from international diversification. More globalization, less segmentation, less correlation. So not universally true. We still see there are benefits from diversification. There are still far from perfect correlations across classes of assets and markets, but it's not quite as great a benefit as it used to be. So things like deregulation, capital mobility, free trade, globalization of companies have all been some of the causes of this increase in correlation. And we see that decreases in barriers to movement of capital across borders created capital mobility, which also means that the money tends to follow the best opportunities. We also see that correlation tends to increase in cases of crises, like the 2008 financial crisis that started in the United States in one particular market, that for mortgages, which led to a more generalized problem across the financial services sector, which started to draw in international banks like Deutsche Bank and the Swiss banks. And so the next thing we know, we now have a worldwide financial crisis that really started off with one single class of assets in the United States. So the benefits from diversification disappear when you need them most. And we describe that as correlation breakdown. Some of the reasons why we still like international diversification. Markowitz's big idea about the benefits of diversification work better across markets. The more markets, the better we're going to do. So even going into an underperforming market can improve our Sharpe ratio by decreasing the level of the standard deviation because of correlation difference. When we do start to do more work across borders, we also have to take into account currency differences because that will be another factor. Emerging markets can also benefit international diversification because correlation tends to be further away. We have much less correlation between developed and developing markets. So diversification is important, but it's still a problem, especially at times of crisis. To wind up, we'd say diversification started off with a simple idea that said that even random diversification, just picking stocks or bonds at random, could improve the overall performance of a portfolio. Modern portfolio theory, starting off in the 1950s, started off with this one basic idea. The lower the correlation coefficient, even if they're negative correlation coefficients, can improve risk reduction. Our asset allocation decisions basically can improve the overall risk-weighted return of our portfolio, which we describe with the Sharpe ratio. Essentially, it's the most common way of reporting risk-weighted return. Later on in the course, we'll look at some variations on the Sharpe ratio. Just about every other important economist has produced their own measure, but they all work with the same idea. We need to find a risk weighting that's going to help us better compare the rate of return of different portfolios. And of course, we saw that international investments can help improve risk-weighted returns.